Greetings from sunny Barcelona. Let's hope it is, as I've gone all that way. Anyway, okay, here we go. So at various points, I'll tell you to pause this video. So pause it. But we'll have a go at a lesson. Don't know how long it's going to take, and we'll have a go at making some notes at the end. Yeah. But I'll come back first thing Monday and just check that everybody's okay with it. So what we talk about, on in Wednesday's lesson, was this idea that we needed unconventional monetary policy, and the reason for that was that interest rates had fallen to zero and the economy still wasn't recovering. So we needed to do something different, from what it is that we would standardly do. Interest rates had been cut during the financial crisis. Interest rates were cut from 5.75 down to 0.5%. The bank rate was cut by that amount. In COVID, they cut interest rates from 0.75 down to 0.1%. But as we said before, there is a zero-bound problem. You can't cut interest rates below zero. And therefore, what that means is that you're going to need to do something else. And this is where we introduced the idea of QE. And QE, at its heart, QE was centered around the idea that what we were going to do was we were going to increase the liquidity of the financial system. Okay, so we had a look at this. On Wednesday. Over on the window ledge, you'll see one of these. So it looked like this. So with a friend, or failing that, somebody who's near to you, read that through and answer those two questions. What is QE basically intended to do, and what are the what are its key elements? So have a look through. You can use this document plus what you remember. Pause this video now. So once I forgot to say play it again once you finished, but I assume you managed to get there. So fine. So if you look at this document, what it's really saying is, what's QE basically intended to do? Increase the liquidity of the financial system. By what it's doing is by increasing the money supply. MS, the money supply. What were the key elements? What we said is the key elements were the creation of new money. That money was then used to purchase assets. And what that did is it led to a decrease in yields on those assets, especially bond yields, and it led to an increase in those asset prices. And the combination of this increased liquidity, decreased yields, and increased asset prices, that was intended to lead to an increase in aggregate demand, which in turn was supposed to lead to an increase in inflation. So the central bank was quite worried about the risk of deflation during this period. So hence that was the purpose behind it. Fine. Okay. So now now what we need to do is to look at that in a bit more detail. So the other thing you'll find is on the window, you'll find a big version of this. It's an A3 version, and if you look at it, you'll see there are lots of flows. It's like the interest rate one with particular boxes. What I want you to do is, with some partner or other, explain each one of those little text boxes. So on the document, there are lots of little text boxes. Kind of here, and here, and so on. So what I want you to do with that person, is to make sure that you can explain each of those fully, and then I want somebody, just to go through each one and see what people are thinking. So share your ideas once everybody's got to the end about what exactly is going on both each of the little text boxes and the asset prices themselves. Okay, so pause the video. When you've done that, play it again, and then we'll be there. So you have now looked through that, and here we have that flow chart. So we look through it, then obviously to start with, we've got this direct cash injection. Bank creates new money to buy assets from private sector institutions, and so we're normally talking about the banks also from insurance companies, pension funds, and so on. As a result of which, of course, the demand for these assets goes up, and therefore their prices rise. And obviously, those two things are linked. Corporate credit markets are unblocked. It just means that people who are trying to sell financial assets, can actually sell them and get cash for them. At the same time, of course, there is more liquidity in the system. As it says down here, actually private sector institutions get cash. So actually we've swapped bonds for cash. Yes, some institutions might simply spend that cash, which would feed through into aggregate demand. But importantly, banks now have more spare cash. During the financial crisis, a lot of banks got close to becoming bust. They made some bad loans that they weren't going to get that money back on. And so by giving them cash reserves, they were now able to take some risks and lend some money. As it says down here, increased reserves mean banks can increase their lending to households and businesses. At the same time, we said that asset prices increase. Because they're increasing, assets are a form of wealth. Total wealth increases. What it's not really saying here is it's saying, well, it says here that asset prices mean lower yields. And what it's saying is that bond yields feed through to a lower cost of borrowing elsewhere. So if the cost of borrowing to the government is cheaper, that tends to have knock-on effects on other borrowing. What it isn't saying, I think, no, it doesn't, is the other point that we made when we were talking about this, which is that lower yields here mean that people will now actually invest into other assets as well. So it's not just bond prices that go up. Because the yields on bonds are lower, people will buy shares, people will buy property, and those asset prices increase. And as it says up there, total wealth increases. Higher asset prices make people more wealthy. Fundamentally then, we've got greater confidence. People are more willing to spend because of all of these channels here. There's more money, more loans, greater confidence, probably lower interest rates on certain types of borrowing. Spending increases, and therefore, because spending for us is aggregate demand, and therefore inflation rises. So that's how the Bank of England sees that as going. Right, fine. So the next thing to do is to pause me briefly in a minute. Wait, and go to the link that you'll see. I haven't put it in yet, but there's a link immediately below this video that links to the Bank of England that's going to explain the same process. Listen to their video. It's only a short one for a couple of minutes. And then come back here. Okay, so now it's time. So hopefully now you've made some sense out of this. So now what we'll do is we'll make some keynotes that sum up what we so far know about QE. Obviously, I'll come back on Monday and double check that we're okay with this. And on Monday, we'll also evaluate the extent to which we think QE is beneficial. It is up in the notes section in the usual place. So if you scroll up to there, you'll see that we've got it's just in our usual notes place. We've got interest rate control is one way in which we can create monetary stability. The second way then is this idea of QE. I expect I'm almost certainly going to go too fast here. So feel free to look at me on your own device or pause me or whatever it is that you think is going to be appropriate. I think one of the most important things with QE is it is not quantity of easing, which I've seen written in exams. QE is quantitative, meaning an amount, easing meaning an increase in the money supply. But you never need to write quantitative easing, you can just call it QE. And what we said is that QE, its kind of subtitle, subheading, is an asset purchase scheme. For many years, there was no need for central banks to use these things. They relied on interest rates. So if we ask ourselves, why was it necessary? What we can say is that interest rates were already cut to zero, to close to zero. So therefore, we'd reached what was called the zero bound problem. Yeah, in other words, negative interest rates aren't really possible. Yeah. And secondly, business and consumer and bank confidence remained very low. And specifically in the financial crisis itself, this isn't always true, it was true in the financial crisis, banks themselves had low liquidity. Their cash reserves had been lost because they'd made bad loans that they weren't getting that money back from. Yeah, so they had limited cash to lend. So that's why it's necessary. So how does it work? Yeah, and this is this section is this section is the key section, and once we've done this, you can bugger off. Yeah, how does QE work? What we said, is that the central bank creates new money and uses that to buy existing government bonds. So the most important thing here to bear in mind is it's not buying them from the government. So to buy existing government bonds from financial markets. So it's not giving this money to the government. So, so not from the government. Because what it's trying to do is to get more cash, it gets more cash into the system. So we say, well, what are the effects? Firstly, what it means is there is an increase in demand for government bonds. We said what that does is it leads to an increase in the price of those bonds. And therefore, a decrease in their yield. And we said that you can work out, if you want to work out the formula for bond yield, we said the bond yield was the coupon, which is the fixed interest payment, divided by the price times 100%. So if the price goes up, then the yield is going to go down. So firstly, the price of bonds goes up, and their yield goes down. We said, secondly, there's more cash is in the financial system. So this might, directly increase consumption. But what it will do is it will eventually mean that there'll be more cash in banks. So banks now have more liquidity, so therefore they're more likely to lend. They have more cash that's available, therefore they're more likely to lend in general. And this combination of an increase in cash and a decrease in bond yields puts downward pressure on other interest rates, for example, like on credit cards. So obviously the central bank's interest rate is close to zero, but other rates aren't. Yeah. So because banks have more cash, they want to lend it. That increases competition between those banks, so interest rates on things like credit cards might go down. And finally, the third effect, we said, is that the decrease in bond yields. What that means is that new investors will now see bonds as unattractive. Their yield is low, and therefore they buy other assets like shares and property, which again leads to an increase in their price and also decrease in the yields on these as well. So shares have a lower yield, and property has a lower yield as well. So, what that means, is that aggregate demand is going to increase. Why? Because one, there's an increase in wealth. Those who haven't sold their bonds, now feel more confident. People have higher house prices and share prices. Secondly, there's an increase in the liquidity of the banking sector. So therefore, there's going to be more possibly cheaper loans. And we said three, those who sell bonds have more cash. So again, that could lead to an increase in consumption. So because aggregate demand's increased, that puts upward pressure on growth, and should put also upward pressure on inflation, hence preventing the deflation that the central bank was worried about and returning inflation to its 2% target. So therefore, the increase in aggregate demand helps prevent deflation. And returns inflation to the 2% target. Okay, so good. Once you got that, feel free to go. Hopefully I haven't fucked up the timing completely, and we're not, I won't reach the end of the lesson in the middle of this, or hopefully we're not 2 minutes in. I'm sure that's not true. As I say, I'll go over this again on Monday. If you've got any questions, ping me in Teams. If somebody could just ping me just to let me know that this kind of vaguely worked or didn't, or it was a total car crash, then I'd be grateful. But otherwise, have a good weekend. Bye.